out-of-state investing isn't that scary. It's not. Once you get into a couple deals, you realize that doing this sight unseen isn't actually that hard if you get some tactics in place. But most investors that at least come to me, and most investors on this Instagram page that talk to me about it, are scared of investing out of state. There's a lot of uncertainty around it, right? That's kind of this fear of the unknown that most people cite. And I think a lot of the questions are around, I don't understand the market, or who's going to manage it? The answer is kind of obvious, right? But we'll talk about that later. How do I get work done to a property? There's a whole lot of like, if it's not going to be me, if I'm not there, and if I don't know this market intimately with my own eyes and can't feel it with my own hands and smell it, because there's some smells to rental properties I've heard. I didn't have to experience that ever. Then they feel like they're not going to be able to succeed at it or can't control it effectively, and that's just not true. So today we're going to give you a little bit of like the why behind that psychology of what makes people afraid of investing out of state. I'm going to turn up this light a little bit. I think you guys need a little more brightness. And I'm going to give you 10 pro tips from the trenches from many, many deals, sight unseen, 100% out of state, on our end that, well, we learn from getting burned. We learn from maybe barely avoiding getting burned and just through successful deals, so you could take them and apply them to yourself and maybe jump in and pick this up a little bit faster than we did over here. Before we do that, so I'm going to pour a whiskey. I'm going to talk about coupon codes. I know that's why like most of you are here. You want some free spreadsheets, I guess. Kind of silly to me. Pay the $35 if you don't get the 25 today, but if you do get the 25, congratulations. Before I tell you the coupon code, I got a disclaimer for you, and I'm going to pour my whiskey too. I'm going to have a pretty, I always say I'm going to have a light pour, and that wasn't a light pour. The coupon code is not active yet. It's going to be active right after this live. I will announce it after the live. It is 8 a.m., and I just have kind of this like, calling card of having a whiskey on lives. They used to be at noon, and people wanted me to keep having it, so now I'm having a whiskey at 8 a.m. or half a whiskey at 8 a.m. The coupon code that I'm about to give you is not active until after this live. I'm going to announce it after this live on an Instagram story. I'm going to give you the link to the page as well where you can download the digital products for free, right? If the coupon code slot is not available prior to clicking the checkout button or the pay now button, it's pretty obvious, right? That means all 25 coupons have been used. I'm giving away 25 copies, right? So if you click buy without entering a coupon code, you are paying $35 for a product like it says, or it says pay now. I already had a coffee, Rob. I already have a coffee. So now it's time for a whiskey. I'm not going to finish it anyways. So the coupon code is no planes. NOPLANES. There it is right there. If you could read backwards. Why is it no planes today? The coupon code is no planes because I don't want you guys flying out and seeing these small rental properties that you're trying to buy out of state for pretty cheap. I want you to get in the mindset of treating this like a business and finding a way to purchase these things without having to use you as the primary vehicle of decision making or process, at least, right? You can make the decisions, but do you have to operate the process at every step along the way, or can you just monitor it and go ahead and check, sign off at the end because you've seen everything you need to see based on other people's work and collection of information? Here's the thing, guys. I want you to soak this up. Buying out of state. Cheers. This glass is pretty dirty. Buying out of state is 100% the same as buying locally. There is nothing different about buying out of state than there is buying locally. The only difference is you, right, as a person. It is the feeling of, I have to know this market intimately. I have to manage the property. I have to do repairs or see the repairs myself to make sure they're being done correctly. This is the funny part. I mean, these are what people are, these are the things people are afraid of. The first one is, I don't understand the market. You probably don't understand your own market with respect to investment if you haven't invested heavily in it in the first place, right? Like, I realized this because over the course of the past year, as this following has grown, I think Instagram pushes some amount of local presence, and I know TikTok does for sure. So I had a lot of people from Sacramento reaching out to me going, oh shit, you're from Sac, I'm from Sacramento too. What do you think about this investment property here or this market? And I realized that I've lived in Sacramento all my life. I don't know shit about the Sacramento investment market. I don't know a damn thing about it. All I know is the areas that I don't like to drive through or I wouldn't want to live in. And that's all I know. Most of us, if we haven't invested in our own market, especially if we live in a major city, we don't really know the intricacies of the market with respect to owning rental property. We just know which areas are really good, okay, and really bad. And that's pretty easy to figure out in a different market as well, right? Especially if you avoid like the highly marginal areas where you think you might get the decision wrong. Avoid the ones that are like, I don't know if I'm right or wrong. And then it's pretty obvious after that. The next fear is, who's going to manage it? Well, who's going to manage it here? Is it you? I mean, I hope not. You shouldn't be, right? You should be able to delegate regardless of where the property is. You should learn how to hire a manager, because real estate is not as an investment, is not something you want to do at a low level of scale. We've talked about this in a recent previous live. Real estate investment, direct ownership scales up very nicely. It's not very nice to you when you're small. It's not as beneficial when you're small. So to get to that point, if that is your goal, which you should have that goal if you're getting into this business, it's okay to have stepping stones along the way, but you should start this with the intention of growing big. You're going to need management. And that means you're going to need to learn to trust someone with monitoring to operate your property locally or from afar. So that fear is kind of null, right? The next one's, how do I make repairs? It's kind of the same concept, right? I mean, are you really going to go and paint your rental here yourself? If that's what you need to do for your rental to be profitable, then you're in the wrong business or it's the wrong property. You should not have to go and do the floors yourself or paint the property yourself for it to be an easy yes investment decision to make. Because if that were the case, why don't you just start a painting business? If your highest and best time, or the highest value of your time per unit time, comes from you painting your rental property and not something else that you're doing, acquiring more properties, your primary source of income, whatever it might be, or flooring your property, why don't you start a construction company if that's really worth your time? And if it's not worth your time to start a construction company, then it's not worth your time to floor your rental property or paint your rental property or replace the toilet at your rental property. You should be able to pay someone and still be able to make money beyond that. So who's gonna make the repairs? Somebody. And yeah, contractors suck. And yeah, you're probably gonna have to go through a couple, and there's gonna be mistakes, and you're probably gonna lose a couple bucks in the process of developing a team. And that's okay, guys. Get used to it, right? Don't be so afraid of small uncertainties instead of being afraid of the uncertainties and avoiding them completely. Try to shrink those uncertainties to the smallest size possible so that they're digestible, so that you can say, I'm going to pull the trigger, and the worst case isn't that scary for me right now. And that's what this live is going to be all about. I'm going to tell you a story first, though. So, of course, a lot of people told me not to do this business, right? My parents were like, why'd you quit your job? This is crazy. This is risky. You know, all my friends. No one believed in it except for my old employer, who I quit from, who was an entrepreneur, was like, yeah, bro, this is a great idea. Get the hell out of here. But I remember a particular guy who worked out at my old gym. He owned a real estate brokerage here in town. He knew the business pretty well, right? He was a successful guy. He'd been doing it for a while too. And we'd always chit chat, and he told me something like, hey, why do you want to invest out of state? I strongly recommend you don't do that and stay local. You want to be able to see and touch the property, and it's a bad idea, right? He told me this back in maybe early 16. I said I was going to fly out and meet people and learn this market a little bit, back when I thought flying out actually made a difference. And he was adamant. He said, you don't want to own a rental property that you can't drive to. And I didn't listen. I mean, I didn't give a fuck, right? I was going to figure this out. Fast forward 5 years to now, we've done 400 plus sight unseen deals. I'm not bullshitting you. A lot of them are these like wholesale flip deals, right? Which we have kind of an interesting hybrid business model. We don't really wholesale, but we don't actually like rehab these things. And we've actually bought over 80 rental properties for ourselves. So done a lot of this stuff, 100% sight unseen. I haven't seen a single one of these. And all these acquisitions are in the last year, right? We just started buying rental properties to keep for ourselves last July. So we've really kind of kept this thing moving fast. We do about 2 deals a week. 2 deals a week close on average this year. Some weeks we close 7, 8, 9. 100% sight unseen. And it hasn't been perfect all the way through. We have only lost money one time, $5,000 on a really small house a long time ago. We've made less money than we thought many times. We've given away money a handful of times, but usually it's not so dramatic at all. It hasn't been. There hasn't been any like crushing incident, but there's been a lot of like little slaps to the face and gut punches and just tuition, right? And I'm going to pass all this tuition from 400 rental properties acquired, this from the trenches, sight unseen business that we've kind of like made our niche, onto you in these 10 tips. Here are 10 things that I think you should know so you don't fuck up as much as I did, and you're going to, maybe more, but you're going to fuck up less than you would have if you didn't listen to these 10 tips. The first thing you're going to look for to reduce the risk of owning rental property out of state and buying sight unseen is rental demand. Rental demand is extremely important. And a lot of this comes down to product selection, right? If you select the right product, that product is inherently less risky than the wrong product. And what is rental demand? For me, it is tenants move in fast. There's a lot of people that want the unit when it's marketed. Tenants tend to pay and stick around for an extended period of time, right? Move in, pay, and stay. That's what I'm looking for. And rent growth. These factors combined offset the risk of turnover. If you have a property that's turning every year, you're spending a lot of money every year. If you have a property that turns often, then you're relying on your management company to do more and to do a really, really good job. And that's something you don't want to do. You want the management company to have an easy job so that they could be just okay at their job. You want to pick an excellent management company or a pretty good management company and give them a job that they only have to be okay at to be successful at, and your rental property is going to have an inherently higher chance of performing, right? So move in, pay, and stay. That's the key. If a tenant sticks around for 2 to 3 years in a market, if it's common in an area for a tenant to stick around 2 to 3 years or more, then that's a good sign, especially in a small multifamily, especially in a working class neighborhood, right? That means that you can buy cash flowing property and have tenants that don't turn too often. If tenants are banging down the door to get the unit, that means the management company doesn't have to take the prettiest pictures or have the best leasing process. They have a lot of people to select from, and it happens pretty quickly. And if rents are growing over time, that means your equity position is protected and that your tenants are going to want to stay a little bit longer too, right? Think about this. If you move into a place, you live there for 2 years or 3 years, and you're paying $850 when you first moved in, and your rent's increased $25 a year, $20 a year, whatever it is, right? Or one of the years it didn't increase, the next year $25. You're paying $875 or $900 after 3 years. But the other units on the market are $950, $975. You're probably not going to want to move, which is why rent growth is so important. It's a preservation tool. It keeps your tenants locked into the property, and it keeps your turnover costs down. And turnover costs are not just vacancy. They're half a first month's rent. They're whatever you got to do to maintain the property, right? It might be a paint job, which is already way more than the deposit. It might just be a touch-up, which is just a couple bucks. But you want tenants that see the market is moving quickly, so holding on to them is really easy. And when they do leave, if you do have a 5-year tenant, a 3-year tenant, a 2-year tenant, and you got to spend a couple bucks on the unit, well, at least you're going to refill it at a higher rent, which is going to increase your cap rate, and then you're going to compress it down. Basically, if your property is generating more income, it's worth more, right? That's how cap rate and net operating income work. That's how the valuation of investment properties work. So your equity position that you've gained in the property from rent growth is going to protect you from the little like knick-knack shit that happens when tenants do move out because you managed to raise the rents. So rental demand is extremely important. Rent growth is a really big part of protecting your equity. The next thing you want is multiple managers. You want to be in a market where you have more than just one viable management option. Now, you don't want to necessarily spread your properties across them, but you want to vet, build that list of management companies, select your top one, work with them, but you never want to be in a position where you go, if I fire this management company, I don't know who I'm going to go to. I don't know if there's someone else. I'm not confident I can find someone else if I fire this management company. That's a really, really ugly place to be in. That's how people get stuck with a bad management company or get stuck having to fly out and see shit themselves or put a tenant in themselves or go to an eviction proceeding themselves. That is the recipe for you not being able to have a reproducible business, right? A reproducible business has redundance. And this is like a really fundamental principle of just business when you think about it aside from rental properties. It might seem a little more, I don't know, like esoteric when you think about it with respect to rental properties. But as a business owner, and that's what you are when you own a rental, You need redundancy. You got to be able to, you can't hire the employee for a position that you feel like if they decide to leave one day, you're never going to be able to find anyone else. That business automatically fails, right? The next thing is the laws. This makes a big difference, especially in this, post 2020 era, especially in working class properties, which are what cash flow, especially these days where every property is expensive. So you've got to turn to working class neighborhoods if you want yield. And you can invest very successfully in working class neighborhoods. That's what we target. That's what we prefer. I think we'll always prefer it to some degree because you can find working class neighborhoods that cash flow, that still have rent growth, that have positive wage trends, migration trends, etc., that are undervalued. But you need the laws on your side, right? You go into that working class neighborhood in the wrong state. If you do it in Illinois and you get a bad tenant, you're going to have quite the adventure. And you want to eliminate just the possibility of these events happening, right? And by event, I mean something that causes you to have to really think about your property, get involved, or be stressed out by it. Landlord-friendly laws seem to change the culture of tenants in working class neighborhoods. And what I mean is they tend to behave differently. If we give an eviction notice or a pay or quit notice in a lot of the markets we operate in, we notice that these tenants, they just move out. They don't wait till we take them to court. We don't have very many eviction proceedings. Sometimes we'll pay the attorney fee to start the eviction proceeding and the tenant will leave before the court date. And it's usually within less than a month. And that allows you to be successful in a market if you have an inherited tenant that turned out not to be that great, which is something that happens at a pretty high clip relative to other surprises when you take on a new rental property. It makes a big difference when you have a tenant that you maybe had for a while that's not performing very well. It's very, very easy to get into the wrong market, buy a property at the right price, a really cheap price, and then realize that these tenants can take you for a ride. So the laws make a complete difference. And tenants don't want to get evicted and have it on their record either. So they just bail. They get out as soon as you tell them hey, I'm just going to evict you if you can't do this. They leave. The next thing you want to do, call the inspector. Always get a third-party inspection, right? Don't just take the realtor's word. Don't just send your manager in, even though if you have a good relationship with your manager, that might be a valuable tool. Get the third-party inspection, but those reports aren't perfect either, right? You want to look at those marginal items. You want to look at detailed photos that they get for you. Don't just take the inspection report photos if they're not super detailed. Ask for a separate folder with photos, get a 3D walkthrough if you can, and then you want to call the inspector. And you want to go through, in your head, kind of, all the marginal items that they listed there that you don't fully understand the scope of work required to remedy, that you don't fully understand the potential cost for. The inspector won't tell you necessarily what it costs to replace something, especially if they don't know you and don't have a relationship with you, but they'll give you an idea of how serious it is and what might need to be done to repair it if they're willing to talk to you about it. And it's all about how you pose the questions, right? But we need to call the inspector and go through the property. You can't leave any stone unturned, and you can't just look at an issue and go, it's no big deal. If you don't truly understand it, you want to know extent, especially with things like little cracks in the basement. Okay, call the inspector and go, do these cracks just need to be filled? Are they fine? Is it just because it rained? Do I just need to extend downspouts to keep water out? Or do I need to put some support beams over here, which is a little bit pricier, $1,500, $2,000? Or do I need to tear that wall out and fully rebuild it? Or do I need to get a foundation contractor in here because it's so serious you can't even give me an idea? Calling the inspector is extremely critical. You miss out on that. Shut up, Siri. You miss out on that, and you might find that the report doesn't really tell you everything you need to know about the property, unless you're really, really confident in being able to assess these things yourself. The next thing is no tiny towns. I have a client that came to me recently. They had a 1031, and we couldn't fulfill their order in the timeline they needed for their exchange. Happens all the time, right? Clients come to us with 1031, they got 45 days, maybe 60 days because they just listed their property. They haven't actually closed escrow yet. And they need $1 million of replacement. They need it in 60 days. Well, we got a wait list, so we can't always fill those orders. Usually we can't if someone's new to us. So they went and found something else in a small town in Indiana, and a small town that's not near any other major metro, right? It's outside of some cities, but far enough outside that you don't have a bunch of banks out there that want to lend to you. You don't have a bunch of management companies out there that are willing to take on a property. The management companies that are out there, they don't have a bunch of resources as far as contractors go or handymen. It's very much like a handshake town, right? These ultra remote towns that aren't attached to bigger markets. I like tiny cities that are kind of like slept on when they're closer to another metro that you can tap into for resources. But when they're really remote, you can get yourself in some serious trouble when it comes to finding people to get things done for you that you can trust. Redundance, once again, you won't have backups on backups when the sample size is so small. And the other thing, what's up, open letter, is that Jake? When the sample size is so small in a market too, you got to think about your next acquisition, right? You're going to spend your effort into building and developing resources in a particular market or building relationships with the resources that you found. And imagine doing all that work and not being able to find a second property when you're ready to buy again, having to go to another city. You need enough of the product. In these small towns, like, you can't really develop in them. You can stick your roots in, but unless you're going to be the biggest investor in town and somehow find a way to get everyone in that town to sell their property to you just so you can have a 40-unit portfolio, tiny little remote cities that are nowhere near other areas can be very difficult. Next one. There is such a thing as too cheap. There's very much such a thing as too cheap. And by too cheap, I don't mean the price you got it for. There's no such thing as too cheap with respect to the price you got it for. You can always get it for cheaper, right? There is such a thing as too cheap when it comes to market value. And the lower a property's market value, the less you're willing to spend on the property to be able to upgrade it, right? Because you got a value ceiling. Imagine buying a house that's like, like one of those flip houses. It's worth no more than $35,000 in perfect condition. Doesn't matter. You get it for $0, $1, but it needs a roof, it needs windows, it needs floors, it needs paint, it needs a furnace. And before you know it, you've already spent the property's value on rehabbing it. Why? Why wouldn't you just buy the perfect one for $35,000? Or here's another situation. Imagine you buy the place for $35,000 in perfect condition, and then the roof finally comes due. Well, you better hope that cash flow is so deep that it substantiates you spending that much on an improvement, because your property's value, it's probably not going up that much, right? I mean, on a percentage basis, it might, but it's just so cheap that the equity isn't there to pay for the CapEx. And I think a lot of investors will understand building real CapEx budgets into rental properties makes them all not cash flow. It really does. CapEx is expensive, and at market value, you're not getting a property with all new mechanicals most of the time. You're getting them with middle of lifespan mechanicals, and mechanicals are expensive. What you're relying on is the rent growth of the property to drive the value up enough so that you can say, it's okay if I spend a little bit of extra money on my property because look how much more it's worth. It's kind of coming out of your equity in most of these situations. It's very hard to do that with a tiny, super cheap property. I say single family homes that are like can't be worth 60 grand at market value, and that's like the bottom, pretty tough to buy. Multifamily, duplex, triplex, fourplex, above, that can't be worth like 45 a unit minimum, that's the floor, maybe 50 nowadays, probably too cheap to buy. You want the market value to be at a level where you could spend a little bit of money on the property. And don't forget the cost of maintenance on a property and the cost of insurance maybe on a property that is such a low value that has really low rents, right? If a property's renting for $500 but you got it for $30K, guess what? Fixing a sink costs the same as it does on the $100,000 property that rents for $1,200, even though you're only making $500 a month in gross rents. Don't be a flipper on your first project. And I don't mean don't buy and flip the deal, wholesale it, resell it, try to make money. That's not what I'm saying. Don't take on a big ass project on your first deal in a market that you're unfamiliar with a management company that you haven't built a relationship with a maintenance team that you haven't really tested out, or contractors that you haven't gotten to test out a whole bunch. That's not a recipe for success on your first deal. You can take that risk if it's a very small financial risk, or if you got a ton of money and you're just like flipping a $100,000 project and you got millions of dollars and you don't give a fuck if you have a bad experience, fine, go for it. But otherwise, if it's a substantial investment to you, Go with something that's a little bit easier. Like if you have a range, go, I'm willing to handle this much difficulty. This is the low side, this is the high side. Stay towards this side of your difficulty range on the first deal. Please don't give yourself a complex project. Give yourself the opportunity to gradually build the relationships, the experience, and the processes early on, unless you really want to dive in and you're a complete risk taker and you understand what comes with it, right? And that you might fail and you shouldn't let that shake you. If failing at a deal is going to shake you up and prevent you from moving on to your second and third and fourth, then you should very much focus on reducing the probability of that happening. The next bit too is start smaller than you can afford. So start with something easier than you can manage and start with something smaller than you can possibly afford. If you've got $1 million to spend, I have investors that come to me all the time. They go, I got $250 to spend on down payments, right? I qualify for a loan, whatever it is. And I tell them, okay, cool, let's go spend like 50 of that right now. Maybe 60, maybe 70 on a down payment on a stable property. Start with a smaller bite. You want it to feel insignificant to you so that if shit happens, it doesn't shake you up. I had one of my clients who he's been pushing me on certain stock tips. He trades options and he also holds for certain deals or certain types of stocks. And he loves like growth plays and tech plays and stuff like that. And that's not really me, but he's been pushing me and pushing me and pushing me. He's bought a couple properties from me and he's a smart guy and he has a significant portfolio. I have a very small stock portfolio compared to my real estate portfolio. He seems to be overweight in his stock portfolio. And he's like, dude, you know what I like today? I like Palantir. You should pick up a couple shares and just hold on to it long term. It dipped a little bit. Good stock. You know, that Kathy Wood lady from ARK Invest has been pushing it pretty hard. Grab some. And I'm like, whatever, dude. Fine. I'll grab 300 shares, about $6,000 worth. That was an amount to me on a company that felt like it's not going away. It'll probably be worth more at some point. Maybe it'll go down tomorrow. I don't know. That was a small enough amount for me to say, fuck it. Who cares? I started on the very low side of like my resource spectrum for that. I would do the same thing with out-of-state real estate if I were you. The next bit is managing your team, right? This is the 9th one. You got to manage your team, folks. You can't just put people in place in a business of any sort and then just turn away and allow yourself to create all these blind spots. You can't allow yourself to create so many blind spots in your business just because you think you have a manager that seems good. And then you're mad that they didn't do their job well enough, or that a rehab was more expensive, or it took longer to get a unit turn, or you didn't get the photos that you wanted to. You've got to have something in place where you're not just relying on trust and you're not overworking. You're not doing their job for them, right? But you got to be able to monitor. Look at those monthly statements from a management company. Make it very clear what your plan is when you take over a property. Here's the work I want done. When can we get it done? Do you think this is something we should do? What do you think it'll cost? Can you get some quotes? These are the rents I'd like to get upon renewal. What do you think is realistic? Form the game plan, set expectations, right, up front. And you can't be a firm asshole about it. These management companies are running their own businesses. You have to respect them and allow them autonomy, right? They know what they're doing if they're good. But you still have to go to them and say, talk to me here. Here's what I'd like. Can we find something that we can both agree on as far as expectations go? And then kind of timelines and costs and all those things. And then see it through every step along the way. Follow up. Ask questions. Let them know you're there without being overly nitpicky. Strike the fine balance. And you'll have a more successful outcome when you delegate. That's a delegation tip across the board, right? If you have employees, we got to do a better job of setting clear expectations and putting processes in place, and then allowing our people just to operate them. And then just checking in on them, without getting in their way, without stopping them from doing their jobs, or without having to do it ourselves, because that's not what we pay them for, right? God, I had a story for you, and I completely forgot it when it came to the management thing. Oh, clients come to me all the time, investors, and they go, every once in a while they'll say this, actually. They're usually pretty savvy now and they don't say this, but investors will come to me to purchase a property, and you know what we do? We buy these things at a discount from market value. We resell them at market value. So we do take title, we buy them cash, and we just immediately resell them. We don't usually do work to them. It's kind of like a wholesale business, right? Not exactly wholesale, but we'll get a bunch of due diligence done. Third-party inspection. Our clients get appraisals through our preferred lender, and it's through a big bank and a big third-party appraisal company, First American Valuations, not some like side hustle guy who goes out on the weekends and does appraisals. It's not who does U.S. Bank's commercial valuations. It's always this consistent institutional appraisal company. There's title work. They pick their own property manager. Even though we give them recommendations, they can pick whoever they want. They can vet the property through the manager. They can call the inspector. There's a bunch of stuff in place for them to do their due diligence. We're just delivering these resources to them so they don't have to go hunt them down if they don't want to. They can call the city, they can call the utilities company, right? Figure out what the usage history is. All these things are put together for our investors, but every once in a while, we'll get a client that gets on that intro call with me and goes, "Hey, Elliot, do you have referrals? How do I know I can trust you?" All right, one, there's no way we're giving out referrals because our clients are 40 a year, 50 a year actually buy from us. And then we have 20 new investors coming to our platform a day without advertising. So it's impossible for us to ask our 40 or 50 relationship buyers to pick up their phone. These are high earners who are moving a good amount of money with us, right? They don't have the time to pick up the phone and do referral screening calls for potential clients that we don't really need because we have a big wait list. So we built this system where they don't have to trust us. And I tell the clients all the time, these new ones that are skeptical, they go, "How can I trust you?" I go, "You don't have to." That's the thing about our system. I don't want you to make a decision based on your trust in me at all. That's a very bad position for me to be in as a business owner, because then I'm kind of on the hook for representing them and absorbing the risk of the property. And I don't want to be. There's inherent risk in investing in real estate, right? We do everything we can to reduce these risks and to guide and act in the client's best interest. However, they're making their own decisions and we're giving them every opportunity to do so. There's no handshake deal in our business. And it's the same when you have a relationship with a manager or you have an employee on your team that's doing something for you. You don't want to have to rely on one of these. Right? Let the systems do the work for you. Let the systems do the due diligence for you. And the last bit is tip number 10, margins of safety. You need margins of safety on your deal, especially if it's an early deal, especially if it's remote and you have a little bit less control, right? You need to be able to absorb a slightly higher rehab cost in the event that it is slightly higher than you'd be able to get if you were to go out there and find a handyman yourself. And that's okay. That's part of the business, right? You need to be able to absorb a surprise expense, a surprise vacancy, switch from one management company to another if anything does go wrong someday. Hopefully it doesn't. It doesn't happen very often with us, to be honest. Our clients switch management at a very, very low incidence rate, and we've fired completely management companies very rarely. And when it does happen, it's after a good amount of time of success with them and then just something changed. So it's not this thing you should be doing every year, but you should be able to soak it up, right? And the way you build margins of safety into these properties is, I would say, especially if you're new to out-of-state, cash flow. You don't want to buy properties with no cash flow, break even, 5 caps, right? Break even cash flow, negative cash flow, appreciation only plays. Cash flow is your margin of safety. And that's what I educate my investors on too. They go, "I want this for the income." I go, "This is just a wealth storage vehicle, right? The income could be good. And it usually isn't year one, right? You're usually spending a little bit of money on fixing up your property. It's an investment and it's a long-term investment, right? It's not supposed to make you rich today. It's not supposed to buy your Ferrari today. Right? It's supposed to be something you keep pouring money into until it becomes substantial. It grows over time, the rents grow over time, the equity gets paid down, it appreciates a little bit, the tax benefits offset the rental income, and then one day all of it in its entirety is making you a lot of money and worth a lot while it's at it too. But for now, cash flow is your margin of safety on these out-of-state properties. So don't buy these ultra-low cash flow deals out-of-state. Don't buy deals that are in bad shape that have ultra-low cash flow out-of-state and hoping they'll appreciate. And if you can't find a property that cash flows well, or if you're looking at an opportunity that doesn't have a ton of cash flow, maybe it is a 5 cap, maybe it's really under rented, right? Then you need a little bit of value. You need margin of safety in the property's value. We recently sold a property to a client, and we put it out to our entire investor list. It was a 6-plex in Racine, Wisconsin. We put it out for $260. It was all 1-bedroom units, but it was a nice conforming building, right? 3-story, all side by side, pretty well maintained, pretty new mechanicals. The seller was pretty respectable. There was an attorney involved in the deal too, which is we like when sellers bring an attorney to the deal. It usually means that the seller's official, right? They're not just trying to jip us through the whole process, because the attorneys will kind of keep them honest, even if they're on their side to some degree. And the property was only a 6 cap because it was so under rented. But the upside was a 10.8 cap. And the property would have, at market rents, I would have sold it at an 8 cap, which would have been $350. And our investors know that they have a lot of margin of safety in that because they can get a mild rent increase and the property is easily worth $300, $310, $315, something like that. That's another form of margin of safety. If you can't get deep cash flow in your property or a substantial cash flow position, have a little bit of equity. That protects you too. Those are the 10 tips. I'll go over them one more time, just summarized. Number 1, rental demand. These are things that keep you from getting burned when you invest out of state, right? Rental demand. Number 2 is multiple managers. Number 3 is landlord-friendly laws. Number 4 is call the home inspector. Number 5 is no tiny towns, no ultra remote cities not attached or at least near a bigger market. Number 6 is there is such thing as too cheap. Number 7 is don't take on a gut job on your first deal. Number 8 is managing your team. You got to do it actively to some degree. Number 9 is starting smaller than you can afford to. And number 10 is margins of safety through cash flow or equity. That's what I got for you guys. I guess I can give you a wrap up, right? The whole point of these things are to show you how to end these 10 tips are to show you how to engineer risk out of your business. That's really what it is, right? And it is a business. And if you're not doing these things or not thinking of these things, then you're not treating your rental properties as a business. And if your rental properties rely on you, personally, you to be successful, then they're not an investment. They're not a business. It's your job. That's what it is. It's a job with some working capital that you bought for yourself. You've got to take the next step. You've got to put some things in place to make it so that inherently you aren't needed for your investments to be successful. Right? Or you aren't needed at every step in the process for your investments to be successful. That's all. Cheers, y'all. I need to breathe a little bit. That was a lot of talking. It's a fucking lot of talking every week. What am I talking about? Sometimes I forget. It's 8 a.m. when I have a sip of this because it tastes just like it does at like 8 p.m. If I can be honest with you guys. Hit me with some questions. I'm down for Q&A. I've got my breath in. If you send me a deal to buy, what's the finder's fee? Depends on what we can buy it for, what we could sell it for, how much spread is in it. I'm glad to give out like a standard finder's fee if you let us do all the talking to the seller, and we'll just sign like a non-circumvention agreement, which I would prefer actually, because our process for getting these deals negotiated is really good. We've been doing it for years. We've done it over hundreds of deals. So if you just want to bring us like a lead and we sign an agreement saying that if we close on this thing, you're going to get a flat fee, we're glad to do that. If you bring us something you've already teed up, that's fine too, even though we prefer to control the process. And you can bring it to us at a price that you think we'd buy it at. And the worst we could say is no, or here's our counter. Here's what we could pay for it. What do I think about multifamily homes in San Antonio? The market's gotten expensive. Man, it's really priced up. And here's what people are doing in markets like San Antonio. I saw like months ago, maybe they're even more expensive now, C-class properties going at a 5 cap there. Like true C-class, like not like B-, right? Not like a working class property in an otherwise relatively nice neighborhood or decent neighborhood. True C-class properties going for a 5 cap. And you're gonna get like a 3.75, maybe 4% interest rate on an investment loan right now, unless you have like a wholesale relationship with a lender like we do. And that's gonna lead to break even or slightly negative cash flow. And don't forget those property tax reassessments. If someone was assessed at a low value because they bought it cheap, they sold it to you at a higher value, a fourplex for $250 in San Antonio, your property tax bill is gonna be fucking nuts. It's gonna be like $8,000 a year or something like that, $9,000 a year maybe. I don't love the market because of how hyped it is. And I think what's happening in a lot of these markets is, one, there's a lot of liquidity, right? People have so much money in their pockets that they just need to spend it, so they're lowering their standards. They're like, I just don't want this money in my pockets. Number 2 is people are seeing rent growth. So what they're doing is they're pulling value forward, right? They're willing to pay tomorrow's price, even though the value is a little bit too high today. They're going, you know what, this rent's gonna keep growing, and by next year or 2 years or 4 years from now, this investment will actually be really good if it keeps growing at this rate. However, investors are a little myopic. Rents don't always grow at today's rate, right? And values aren't always perceived by the open market as bullishly as they are today, even with rent growth present. Sometimes investors will go, you know what? I don't want to bet on tomorrow's rents anymore. Even though it's going to go up, I'm going to keep my cash. I'm going to save it for other assets. Maybe interest rates go up and it changes the cash flow. That makes a big difference, right? So pricing things forward or pulling value forward is something that's happening in a lot of popular growth markets. And San Antonio, I think, is subject to that. Oak Hills in California becoming tempting. Interesting. 5-fam in Racine for 180. Good deal. It depends on the quality of the property and the location in Racine. Could be a good deal if it's a well-maintained property throughout and it's occupied and it's bringing in anywhere near market rents. Could be good. If it's in the roughest part of town and it's not in great shape, the seller says it's fine, but then when you get in, you realize it's far from fine, which happens all the time. People come to me and go, yeah, property's in a good condition. Then they get in and they go, no, it's not. And that's because they aren't asking the pointed questions of the seller or the broker or whatever it is that really reveal the condition of the property. Let's see. More questions, please. I'm not going to let you in on the video, guys who are asking to be on duet the live or whatever it is. Specific landlord laws you should look for. Resources. I don't dig into like the municipal codes in any of these markets. I lean on my property managers and I ask them questions like, what's an eviction cost? How long does it generally take to get a court date? How long does it take for a tenant to leave? And then how frequently, when you file a notice to pay or quit, which is basically you got to pay or I'm going to start the eviction process, or when you file an eviction notice to the tenant, how frequently does that tenant just up and leave or start to comply? Is it something that you have to go through? So you want to just understand like the results of the process at a couple steps along the way, like the outcomes you can expect. I don't think you need to be an expert if you're just buying a couple small properties. You don't need to be a housing law attorney. Thoughts on Jackson, Mississippi? I don't have a banking footprint in the market, so I've just kind of not bothered with it. I don't love just the trajectory of it necessarily, but there's cash flow and cheap properties out there. It could work, I suppose, but I just don't see what's going on there. Even in these cheap markets that we're in, like Northwest Indiana, Racine, Wisconsin, there's something happening, right? That's clear, and there's other stuff nearby that's like feeding into that. And Jackson, Mississippi is just kind of isolated. There's really got to be something happening there to motivate me to get into cheap properties, working class properties. I want them to not be as cheap at some point in the future. Thoughts on Miami? Overpriced, man. I mean, it's just a hot market. A lot of people moving to Florida. I think it's like this trend that people think is going to continue perpetually, and it might to some degree, but they're very much overpaying for that today because every investor is dying to get on the next growth train today. There's a lot of greed out there in the market. So growth is overvalued. Like the premium people are paying for potential growth is crazy right now in the market. So something's got to really beat the rest of the assets out there for it to be justifiable. So I think. I don't know about Southern New Hampshire or New Jersey. Jersey's expensive and the taxes are freaking crazy. And I hear the laws are not very landlord friendly. Ali, Airbnb versus long-term rentals are two different businesses. Right? Long-term rentals are a little more on the passive scale, although they're not fully passive if you're a direct owner. Airbnbs can be more active. Now you can hire a manager for these things, but it's still requires some oversight from you. Now, my biggest concern with short-term rentals right now is it's very much changed the market valuation of the single family home, right? You're in these neighborhoods where single families to homeowners are definitely not worth as much as they are to an Airbnb investor. An Airbnb is highly subject to regulatory change, and it's and these are volatile things, right? Fickle things. Highly subject to regulatory change, and Airbnb or short-term rentals in general are also highly subject to demand volatility from the actual customer. Now you got to remember right now, everyone's got full pockets. Economy's good. Young people are coming off a lot of bennies, a lot of unemployment bennies. They're spending money and they're going into Airbnbs. They're traveling, they're vacationing, they're having fun. I see it all the time, dude. Like siblings of friends that are going on expensive trips that they can afford because they got $4,000 a month each on unemployment while they were living with their parents before, right? And there's also a lot of pent-up vacation demand. So what that means is this really driven up valuation of Airbnb because they're performing really well. So people look at them and go, look how much money this thing's making. I'm going to pay this premium for it more than what the homeowner would pay, and the homeowner pays more than what the long-term investor would pay, right? So they're paying like 2 tiers of premium over what an actual investor would pay for that property based on its Airbnb income. Now, what if the demand for travel changes, which is something that changes very readily when the economy shifts. When people don't have a sense of, I've got money to blow, one of the first things they cut is their vacation, right? Like they go from taking like the flight out to Miami or the flight out to Nashville or whatever it is for a long weekend to the drive to Tahoe for a day, or even a fucking hike out at the coast. People stop affording shit, right? They really cut their costs. Like they're gonna stop going on their vacation, they'll just go to the brewery down the street from their house. It happens every time the economy cycles, and you see it in like vacation homes. Vacation home valuations are highly volatile. Now imagine income-driven valuations that are almost like a levered play on vacation homes, right? They're not people that can actually afford these as a luxury. They're people that are buying them based on how much money other people are willing to spend to lease it from them. And I think there's gonna be some serious volatility in the Airbnb asset. That's my opinion. I mean, I'm kind of a bear when it comes to speculation, but I know that like luxuries go up and down hard when the economy changes. Bad economy, dude, you're gonna get a fucking Lambo for half price. Good economy, they're selling at over market value for used ones. Look at them right now, right? I saw an interesting bit on the Lamborghini Huracan. The Lamborghini Huracan last year, like hard of COVID, was selling for like, just pick a model, right? 2017 or something like that. They were selling for like 160 on eBay all day. Now that same car is selling for like 250. Same exact car, 250 on eBay. See how people's opinions change, right? See how people's sentiment affects what they're willing to spend on, even people with money. Because usually, there's a lot of people that barely have the money to afford it. They're just stupid. But people are emotional. They're really emotional, and they're willing to spend on what they deserve. Their rewards. A lot of people go, I deserve this. I deserve this. I just really need this. Everyone else has it. Shit. A lot of other people start doing it too, right? My friends are all going on vacation. I should too. Same shit. What is wealth? That's an interesting question. I mean, I'm not going to get like super kiki philosophical on you. It's just whatever you want it to be, dude. For me, it's just doing what I want. Right? Like I've moved past the point where like the money affects my lifestyle. It's not like I'm not going to be able to leave enough money for my kids or pay for my parents' house and, be financially free myself. Just do what you want to do. That's what it is. I like working my ass off at this thing. If you want to do a thing, the ability to do that without being like hindered by, financially driven factors, that's probably a good enough definition of wealth for most people. Arkansas market, thoughts? Not a lot of multi. I've had success within Little Rock, and I haven't looked in like those other secondary and tertiary markets in Arkansas a whole lot. Hit me with some more questions, guys. Conventional 20% or FHA loan on first-time duplex investment. It depends on if you can afford the debt. And if you got other plans with the cash. Like a lot of people go, oh, why would you put 20% down? Just put 3.5% down on that duplex, and then you got all this other money to invest. And then you go to buy the investment property, and the lender goes, yo, bro, you got way too much debt. You're broke. You can't afford this shit. So have a conversation with your lender and see like what can your DTI support, right? If it's a conventional lender, or if it's a commercial lender for the next deal, say, hey, I plan to buy this duplex to live in. If I go full FHA and these are my payments and this is my PMI, which is higher, and then here's how much debt I'm going to have on my name too, and this is how much cash I'm going to have left, and here's what my income is. How much can I afford on a second property? That's the question I would recommend that you ask. A lot of people hurry to get into a deal because they go, oh man, I just need to get the money out of my pocket, or oh man, I just need the tax benefits, or oh man, I just need to get in and I only have to put 3% down. That's great, but how does acquiring that debt affect your ability to make your second and third investment? A lot of people don't think many moves ahead, right? Which is why I'll turn down deals and sometimes pay more taxes at the end of the year because I don't want to add an extra $500,000 of debt on a deal that I don't badly want that's going to affect my ability to get the next one down the road. What else we got here? South Carolina, I don't know. I haven't had much success in it. The markets that have high enough rents, are too expensive, and then the markets that are cheaper have really, really low rents. In South Carolina, I don't really love it, to be honest. I don't really love Ohio either, at all. And I've told you guys a couple times why. I'm not going to go into like the gory details of the markets, but I like Columbus, but it's too expensive. Everything else is kind of dinky out there. Do you think if the economy tanked, I'm going to get some fucking flack for saying the rest of Ohio besides Columbus is dinky. Do you think if the economy tanked again, it would be as bad as 2008? That's a very hard question to answer. I'm going to keep scrolling, so just updates. That's a very hard question to answer. I don't think the real estate product is going to be as impacted as it would be in 2008. I think universally, at least, it won't be. Because banks are in really good shape, right? And it's objectively, they're in much better shape. You could argue that they might be doing some subprime lending on the back end. We don't know for sure. There's much more regulation in place to prevent that. They just learned. Banks are required by the Fed to keep much higher reserves. They're being ridden. And during COVID, they were all stress tested too. So very recently, they were like pressured, tested by the Federal Reserve to see what they can withstand under worst case economic circumstances. And banks did really well, actually. So I don't imagine we're going to see a real estate crash like '08. There'd have to be some deeper driver, because what happened is like demand fell off a cliff for real estate, right? And there was like a systematic like failure of what supported the real estate market. So it was like an accelerator. I don't think we're going to have that accelerator from banking this time. It'd have to be from something else, but I don't think it's a complete bullshit market. People seem to be able to afford their single family homes and their properties. They'd have to lose some significant income. I think what's really going to happen that affects the economy this time is a major reduction in liquidity that comes from the stock market and cryptocurrencies. I think there's a lot of liquidity that's going to go away, and then people's behaviors are going to change. What they can afford is going to change significantly. Let's see. What else we got? How much crypto do I hold? $0. My business partner with company money, which I don't know if that means distributions or it's going to come back to Ace, but he says it's the company's. Owns a good amount of Ripple, like probably a couple $100 worth or something like that. A couple $100. $200,000. But I don't know. I don't really give a shit. We have access to discounted investments, right? Like imagine working at a restaurant. Let's say you work at like a sushi restaurant, right? And then you get fucking sushi half off, bomb ass sushi half off every day, right? You get to eat sushi for $30. You know, you and your date can just have a whole dinner. Drinks are free, all that stuff. So you pay $30 for a $120 dinner. You probably wouldn't go to the burger joint down the street as often, would you? And pay the same price for a burger, or double the price for a burger as you would for a sushi dinner. That's kind of how I feel about crypto. We just got under contract last night. Seller signed 3-plex worth $225. It's going to need 1 unit turn for $75,000. I'm not interested in throwing that $75,000 in crypto that I'm buying at its current valuation, right? I don't get the opportunity to misprice it. I can misprice it relative to like tomorrow's value, but I don't know how confident I am in that to say that I'd rather spend that 75 on, you know, some coin, whatever it is, even if it's a good coin, versus a property that I know is worth 3 times what I'm buying it for. That's cash flowing too, by the way. It's like a 25 cap. What else we got? Thoughts on owning multiple single families versus one apartment building. I don't hate single families. I say when it's small, it's harder to get lending on. I'm just scrolling. When it's small, it's harder to get a loan on. And it's going to be harder long term to just deal with financing, refinance. When you sell, you have to sell like packages of them or just one at a time for very small amounts. That's the pain. So when I invest in single family, if you're a scaled investor, right? If you have 100 doors, then I think the single family starts to feel small and like a lot of effort for a pretty small unit. As a result, we require single families to be at a deeper discount when we buy them. So we just bought a 10-pack of single families 2 months ago. We got them for $30,000 a pop. They were all in pretty good shape. We sold 5 of them, used the profits to pay for the first 5. So we got basically 5 houses for free. The ones that we kept are worth about 70 to 85 each. Maybe one of them or 2 of them is worth 90. So it's like an instant over double on these properties, and they're renting for between $900 and $1,100 a pop. So like that has to be the kind of deal we see for a single family to make sense for us. And I think a newer investor can get in and say, sure, I mean, I don't have a 100 property portfolio, whatever. If I see a good deal, it's a single family, I'll throw it on and I can do whatever I want with it later. or I could just not accumulate so many of them later on as I'm bigger. But for now, I can grab a couple. So I don't really hate them. What do I look for in a commercial lender? Will they lend to me? Will they lend to an out-of-state borrower? That's my biggest problem is I'm in California. These lenders want to be in the same footprint as the borrower and the property. And that's difficult because like the big banks don't really have an appetite for these deals right now. And the little banks are very, very regional, right? So I don't have a little bank here or even a regional bank here in Sacramento that lends on property that has branches in Indiana or Tennessee or something like that. So will they lend to out-of-state borrowers? I also want to understand, I don't really care about rates. Like I don't care about pricing, right? Get me the debt. Like I'm not that worried about it. I'm more concerned with the bank's health and their flexibility to continue lending to. Like, do they get clamped down on hard? What do they value in the relationship, right? How do I make sure these guys are going to be able to continue to lend to me? And then when the balloons come due, are they going to be in good enough shape to give me another loan? Or are they going to be in tough shape and fickle and temperamental and shit like that, right? That's what I look for in these banks. I got time for a few more questions, guys. Give me some good stuff. I'm not going to allow you to join the video. I'm so sorry. Especially if you don't have like a logo on your name. Come on. I'm not going to keep scrolling up for questions because there's just too many. Give me some fresh ones. Can you tell us more about how you find properties and addresses you want to send mailers to? Well, we got a very niche business. We look for a very specific product, right? Our product is affordable housing in stable condition in secondary and tertiary markets in the Midwest and South. And it's very tailored to what our investors want. So when we look for properties to mail to, when we grab our data, we're getting our data very much pointed towards that type of product. We want a high conversion rate. We don't want to pursue stuff that our investors don't want, that our business doesn't want, right? That's how you end up creating a lot of waste and a lot of cloggage of your sales funnel. Get salespeople busy with bad leads, they miss out on good ones, they don't have time to spend on the good opportunities, right? So conversion rate drops on the good ones, and then the conversion rates are already low on the bad ones, and overall your sales business really gets jammed up. So we target our data, and then I've got a lot of techniques that, first of all, I couldn't even share over the course of like a 1 hour live. Second of all, I wouldn't. It's highly proprietary. Like the consultation fee I'd request for that would be crazy. But we've got a lot of methods to be able to collect that data on sellers and be able to filter that data, because understanding exactly how the county reports property data is very county by county. And then you've got to know, as a result, how to sift through that and learn about how the county reports its data so that you can manipulate it appropriately and be able to target the right sellers. And then you're marketing, right? You can mail, if you're scrubbing for DNC, right? I mean, because you don't want to break the law and just call and text people that like are on the DNC list. You can call or text people, and you have to have a really good sales process to be able to convert. And also like an understanding of like why someone would want to sell to you more than the competition. If you don't have that, then your conversion rates, right? We know exactly why people want to sell to us. We close a lot of deals as a result with a much smaller mailing list, by the way, than like wholesale companies do. These wholesale companies mail 100,000 people to make $2 million a year. Fuck that. Best advice on scaling from 0 to 100 units. And I don't know if everyone saw who asked that comment, so I'll just go ahead and say this without identifying. The best advice to scale from 0 to 100 units is you got two ways to do it. Right? One way is to have a business that generates a lot of income to pay for those units. Two is to have a business that generates a lot of investor money to pay for those units. You see the common ground between the two? You gotta have a business operation, one that generates a lot of resources, right? And if you're at 0, you might have some growing pains trying to get investor money together on a deal like that, because you're not a skilled operator, you don't have a reputation, right? But it's not impossible by any means. You just might have to take it one chunk at a time, or find a really good deal, or take a little bit more of a risk at first because the confidence level is not completely there. But yeah, you need money. That's it. You need money. And OPM isn't as simple as all the TikTokers make it sound, guys. I'm sorry. And I know you trust me at this point, right? Because I'm not one of them. It's not as simple as they make it sound. I gotta go. I've got to go ahead and give this coupon code out, right, for this giveaway. Actually, you already have the coupon code, so I'm going to go ahead and drop the story with a link and then activate it in a second here, post this, and then go on my merry way. And look, guys, I want you to see, this is how much whiskey I consumed at 8 a.m. I'm doing it for the prop. I'm doing it for you guys because I don't think you'd come here if I didn't have this in hand, but maybe you would. Maybe you don't give a shit. Cheers, y'all. Thank you very much for joining. It was a great live. A lot of good questions today. I will see you next week. I'm not going to tell you the code again. You got to watch the first couple minutes. See ya.